There is a persistent myth that building serious wealth requires a massive, unpredictable income, the kind generated by entrepreneurs or high-risk ventures. But you don't need a fluctuating windfall to accumulate capital. Living on a 9-to-5 fixed salary comes with a specific trade-off. Yes, your upside potential is capped. Your paycheck isn't going to suddenly double next month. But in exchange, you gain absolute predictability. You know exactly what is coming in and exactly when. This flowchart maps the fatal flaw in how most fixed-income earners handle that predictability. The standard approach is to pay expenses first, hoping to invest whatever is left over at the end of the month. That path almost always dead ends at lifestyle inflation. If the money is sitting in your checking account, you will find a reason to spend it. Watch the routing change here. The optimal behavior completely bypasses the leftover trap. It intercepts the cash flow the very moment the salary is credited, routing a set percentage straight into investments before you even have a chance to look at it. By locking in that early route, you sever the link between what you earn and what you spend. When your salary inevitably increases, the extra money hits the investment route first, preventing your living expenses from creeping up to match your new income. The starting point for financial independence isn't drastically increasing your paycheck. It is designing a ruthless, mechanical system to capture the income you already have. Before you route a single dollar into the market, you have to build a shock absorber. That means parking 3 to 6 months of living expenses in a completely safe, easily accessible liquid account. Without that buffer, a medical emergency or an unexpected job loss forces your hand. You might have to pull money out of your investments right when the market is down, locking in massive losses simply because you needed cash to survive. This layout outlines the core formula of paying yourself first. The target metric is simple. Subtract a 15 to 30% automated deduction from your take-home pay. Whatever remains becomes your absolute limit for rent, groceries, and entertainment. Relying on willpower to manually transfer that 20% every month is a losing strategy. Setting up an automatic transfer removes the emotional friction entirely. It happens in the background, enforcing discipline without requiring you to make a conscious choice. Once you establish the emergency fund and automate the deduction, your financial posture shifts. You are no longer a vulnerable worker operating paycheck to paycheck. You are a capitalized investor with consistent deployed cash flow. To figure out where cash flow should go, we use this evaluation matrix. It weighs requirements against potential delivery. Look at direct equity. Picking companies requires extensive weekly research. It demands massive time and an ironclad stomach for sharp price swings. You might beat the average market return. You also might pick a company that goes bankrupt, resulting in a total loss of your capital. Real estate presents a different hurdle. Buying property requires a massive initial capital input just for the down payment, shutting out most beginners immediately. While property can generate steady rental income and long-term appreciation, it is extremely illiquid. You cannot sell a fraction of a house if you suddenly need $5,000. Managing individual stocks and rental properties are active asset classes. They require continuous attention and labor. If you are already exhausted after a 9-to-5 workday, taking on a secondary job to manage your money is rarely a sustainable strategy. This is where mutual funds come in. Instead of picking stocks yourself, you pool your money with thousands of other people to hire professionals who allocate the capital across multiple companies on your behalf. The trade-off here is straightforward. You give up the thrill of betting on a single moonshot stock, but you reclaim hundreds of hours of your free time while securing broad exposure to market growth. Exchange-traded funds, or ETFs, take this a step further. Instead of paying a manager to actively try and beat the market, an ETF is built to passively track a whole index, like the top 500 companies in the economy. This side-by-side graphic shows the structural difference. Because ETFs run on simple, passive tracking rules, they charge significantly lower management fees than the complex, actively managed nodes of a mutual fund. Over decades, those saved fees compound into massive gains. Broad market ETFs pair perfectly with the 20% automated deduction we established earlier. Your money buys a fractional slice of the entire economy every single month, requiring absolutely zero decision-making on your part. For a fixed salary earner short on time, these passive engines offer incredible leverage. They completely decouple the act of accumulating wealth from the exhausting requirement of actively monitoring charts. Not every asset is designed for aggressive growth. Fixed deposits and bonds serve strictly as portfolio stabilizers. They provide a predictable, slow trickle of interest to anchor your net worth when the stock market dips. Gold functions similarly. Whether physical, digital, or held in an ETF, gold acts as a historical hedge. It tends to hold its value or rise during periods of steep inflation or economic chaos. But the safety of bonds and gold comes at a steep cost. Their yields are generally too low to outpace inflation significantly over the long haul. You cannot rely on stabilizers alone to build substantial wealth. For the long game, retirement and pension plans offer a unique structural advantage. The government essentially subsidizes your investment by offering heavy tax breaks on the money you contribute, accelerating your compounding over decades. The strict trade-off is access. To get those tax benefits, your capital is aggressively locked away. If you try to withdraw it before retirement age, you face severe financial penalties. Stabilizers and retirement accounts are the defense mechanisms of your financial system. They preserve capital during crashes and protect you from taxes, but they require the aggressive growth of equity engines to actually push your net worth forward. You have to match your asset allocation to your actual availability, rather than trying to replicate the complex, high-maintenance portfolio of an online influencer. This stacked chart represents the time-poor professional profile. It is built for someone who wants guaranteed market average growth with zero daily effort. The capital flows exclusively into broad ETFs, mutual funds, and tax-advantaged retirement accounts. The trade-off is patience. Accept a decades-long timeline. But if you have more time, this structure shifts to the balanced optimizer. It allocates 60% to passive funds, 30% to stabilizers like bonds and gold, and a 10% slice for individual stocks. Maintaining that 10% stock-picking slice requires continuous rebalancing. You will have to monitor earnings reports and adjust your holdings to prevent one bad stock pick from dragging down your overall return. Ultimately, the best portfolio isn't the one with the highest theoretical yield on a spreadsheet. It is the one you can consistently fund with your salary and confidently ignore when the financial news starts panicking. We return to the central truth. Earning a fixed salary is a structural advantage. Because you know exactly what you make, you can build a flawless, automated machine around it. By executing the right behaviors, you force a capped monthly income into a system of exponential growth. The principal gathers interest, the interest gathers more interest, and over time, the math takes over. The greatest threat to that momentum is your own interference. The temptation to constantly switch strategies, pause deductions for something shiny, or chase the latest market hype will break the cycle. Pick the asset mix that matches your time. Automate the inputs the day your paycheck clears. Then get out of the way and let compounding do the heavy lifting for the next 2 decades. Building serious wealth is not a product of how massive your salary is. It is entirely determined by the measurable gap between your income and your lifestyle, channeled relentlessly into assets that grow while you work.